Most people think the stock market is a game for the rich, the educated, or the highly intelligent. They believe success belongs to people with special access, fast computers, or deep knowledge. This belief quietly stops ordinary people from even trying. Yet the truth is much simpler. The stock market does not reward brilliance as much as it rewards behavior. It rewards patience more than prediction. It rewards discipline more than excitement. As Warren Buffett said, "You do not need to be a genius to be a successful investor." This audiobook is written for everyday people. People with jobs, families, and limited time. People who want a calm and realistic way to grow wealth. Here, you will not find secret formulas or complicated theories. You will find simple ideas that work because they are human. The stories and lessons ahead show how ordinary people quietly outperform professionals. They win not by doing more, but by doing less. They win by avoiding common mistakes. They win by understanding themselves. Before learning strategies, it is important to break a dangerous illusion. The illusion that experts always know better. That belief is the first barrier between ordinary people and long-term success. This leads us directly to the first chapter. To win the game, we must first question the myth of the market expert. Chapter 1. The myth of the market expert. From the outside, the stock market looks like a place ruled by experts. People on television speak with confidence. Charts move behind them. Big words create an image of control. This image convinces ordinary people that success belongs to someone else. Someone smarter, someone faster, someone better informed. But this image is carefully constructed, and it hides an uncomfortable truth. Many so-called experts do not beat the market. Year after year, professional fund managers fail to outperform simple market returns. They study harder. They work longer. They trade more. Yet the results often disappoint. This is not because they are lazy or foolish. It is because the market is more powerful than any individual. Benjamin Graham, the father of value investing, warned about this long ago. He said, "The investor's chief problem, and even his worst enemy, is likely to be himself." Experts are not immune to fear or pride. In fact, they often suffer more from it. They feel pressure to appear smart. They feel pressure to act. Doing nothing feels like failure to them. Ordinary people have an advantage they do not realize. They are not required to act all the time. They do not need to impress clients. They do not need to predict the next move. They can simply wait. Waiting sounds passive, but in investing it is powerful. Experts often believe they must forecast the future. They study economic data. They analyze company earnings. They listen to central banks. Yet the future refuses to cooperate. Unexpected events always arrive. Crises appear without warning. Markets react emotionally, not logically. The more experts try to control outcomes, the more mistakes they make. Ordinary investors succeed when they accept uncertainty. They admit they cannot predict markets. This honesty becomes strength. Instead of guessing, they prepare. Instead of reacting, they plan. They build portfolios designed to survive surprises. They understand that not knowing is normal. Warren Buffett once said, "Forecasts may tell you a great deal about the forecaster, but they tell you nothing about the future." Ordinary people take this wisdom seriously. They stop searching for perfect answers. They focus on what can be controlled. Saving regularly. Keeping costs low. Staying invested. Another hidden problem with experts is overconfidence. Success in one period creates belief in skill. Failure is blamed on bad luck. This cycle feeds ego. Ego leads to larger risks. Larger risks lead to bigger losses. Ordinary people who remain humble avoid this trap. They do not assume they are smarter than the market. They respect its power. The financial industry also benefits from the myth of expertise. Complexity creates dependence. If investing feels confusing, people seek help. Help often comes with fees. Fees reduce long-term returns. Ordinary investors who keep things simple keep more of their money. They realize that complexity often serves the seller, not the buyer. Experts trade frequently. They respond to news. They chase trends. Each action feels justified. But activity creates costs. Taxes increase. Fees accumulate. Mistakes multiply. Ordinary people trade less. They let time do the work. Charlie Munger said, "The big money is not in the buying and selling, but in the waiting." This lesson favors the patient, not the brilliant. There is also the problem of short-term thinking. Experts are judged constantly. Monthly results matter. Quarterly performance matters. This pressure forces decisions that look good now, but harm later. Ordinary people can think in decades. They measure success slowly. They allow investments to recover from downturns. Time becomes their ally. The myth of the market expert survives because it feels comforting. Believing someone else is in control reduces responsibility, but it also removes power. Ordinary people who let go of this myth reclaim that power. They stop outsourcing judgment. They stop chasing opinions. They build confidence through consistency. This chapter is not an attack on knowledge. Learning is valuable. Understanding basics is essential. But wisdom is different from complexity. Wisdom knows limits. Wisdom respects uncertainty. Ordinary investors win by staying within those limits. To beat the market, the first step is not learning more predictions. It is unlearning false beliefs. The belief that experts always know better. The belief that activity equals intelligence. Once these myths fall away, simplicity becomes possible. And simplicity is where ordinary people begin to win. In the next chapter, we will see how simple choices often outperform complex strategies, and why doing less leads to more. Chapter 2. Simplicity beats complexity. After letting go of the myth of the market expert, ordinary people face a new choice. They can make investing complicated, or they can make it simple. Most people believe complicated ideas must be better. Complex plans sound intelligent. They feel advanced. They give a sense of control. But in investing, complexity often creates more problems than solutions. The stock market is already complex. Thousands of companies, millions of investors, emotions, news, politics, and global events all collide. Adding complexity on top of this chaos does not create clarity. It creates confusion. Confusion leads to hesitation. Hesitation leads to mistakes. John Bogle, the founder of index investing, shared a powerful idea. He said, "Don't look for the needle in the haystack. Just buy the haystack." This single sentence explains why simplicity works. Instead of trying to find the perfect stock, ordinary people own the whole market. Instead of guessing winners, they accept average results. Over time, average becomes extraordinary. Complex strategies demand constant attention. They require monitoring, adjusting, and reacting. This creates stress. Stress pushes people to act emotionally. Emotional action usually leads to poor timing. Buying high, selling low. Simple strategies reduce decision-making. Fewer decisions mean fewer opportunities to fail. Ordinary people do not need to understand every detail of the market. They need to understand a few basic principles. Businesses grow over time. Markets reward patience. Costs reduce returns. Time magnifies both gains and mistakes. These ideas are easy to understand. They are hard to follow. Simplicity makes following them possible. Complexity often hides risk. When strategies are difficult to explain, they are difficult to trust. People invest without fully understanding what they own. When markets fall, fear rises. Fear causes selling. Simple investments are easier to hold during bad times. Understanding creates confidence. Confidence creates patience. Many financial products are designed to look sophisticated. They use technical language. They promise protection or higher returns. But complexity often benefits the seller more than the investor. Ordinary people who choose simple investments avoid unnecessary fees. They keep more of what they earn. Small savings, repeated over many years, create large differences. Simplicity also supports consistency. A simple plan is easier to repeat. Regular investing becomes a habit, not a struggle. Habits remove emotion from decisions. When investing becomes routine, fear loses power. Greed loses influence. The process continues quietly in the background of life. Warren Buffett often explained his success in simple terms. He said he was not smarter than others, just more disciplined. Discipline thrives in simple systems. Complex systems break under pressure. Simple systems bend and survive. This resilience is crucial during market downturns. Another advantage of simplicity is clarity of purpose. Ordinary investors know why they are investing: for future security, for family, for freedom. Complex strategies distract from this purpose. They turn investing into a game. Simple strategies keep focus on long-term goals. The media encourages complexity. Daily news creates urgency. New trends promise quick results. Ordinary people who ignore this noise protect their attention. Attention is limited. Wasting it on constant updates reduces peace of mind. Simple plans free mental space. Life becomes richer outside the market. Simplicity does not mean laziness. It means choosing what matters. It means saying no to unnecessary action. It means trusting long-term growth instead of short-term excitement. Ordinary people who embrace simplicity build strength quietly. By removing complexity, they remove stress. By removing stress, they improve decisions. By improving decisions, they improve outcomes. This is how simplicity becomes a competitive advantage. In the next chapter, we will explore the greatest force that rewards simple investing: time, and how ordinary people use time to achieve results that experts often fail to reach. Chapter 3. Time is the real advantage. When people think about investing, they often focus on timing: when to buy, when to sell, when to enter, when to exit. This focus creates anxiety. It creates the feeling that one wrong move can ruin everything. Ordinary people learn a different truth. Time matters more than timing. Time allows investments to grow naturally. It allows businesses to expand. It allows mistakes to heal. It allows emotions to settle. Albert Einstein famously called compounding the most powerful force in the universe. He understood that small progress, repeated patiently, creates extraordinary results. Experts often fight against time. They try to speed it up. They search for quick gains. They move money constantly. This creates friction. Each action introduces risk. Each decision opens the door to error. Ordinary people move slowly. They give their investments room to breathe. Compounding works quietly. In the early years, progress feels small. Growth appears boring. Nothing dramatic happens. This is where many people give up. They leave just before time reveals its power. Those who stay are rewarded later. Growth accelerates when patience survives boredom. Time also reduces the importance of mistakes. Everyone makes errors. Buying at the wrong moment. Holding the wrong company. Reacting emotionally. Short time frames magnify these errors. Long time frames soften them. Given enough time, good decisions outweigh bad ones. Market declines are frightening in the moment. Prices fall. Headlines shout fear. Experts rush to explain what is happening. Ordinary people who understand time respond differently. They remember that declines are temporary. History shows recovery again and again. They trust the long path. Peter Lynch said, "The real key to making money in stocks is not to get scared out of them." Time rewards those who stay invested. Selling turns temporary declines into permanent losses. Waiting allows recovery to do its work. Another advantage of time is learning. Ordinary investors improve slowly. They observe markets. They experience cycles. They build emotional strength. Each year adds wisdom. Experts often believe they already know enough. Confidence can block growth. Time humbles everyone. Those who listen benefit most. Time also protects against overreaction. News feels urgent. Stories sound dramatic. Predictions feel convincing. But most news fades quickly. Time filters noise from truth. What matters remains. What does not disappears. Ordinary people who ignore short-term noise gain clarity. Long-time horizons change behavior. When decades matter, daily movements lose importance. Stress decreases, decisions improve, life feels calmer. Investing becomes part of living, not a constant worry. This mental shift is powerful. There is also a personal side to time. Ordinary people invest alongside their lives. They build careers. They raise families. They grow older. Investing happens quietly in the background. This natural rhythm aligns with long-term thinking. Experts live inside markets. Every movement demands attention. This closeness increases emotional involvement. Distance creates objectivity. Warren Buffett said, "Our favorite holding period is forever." This statement reflects deep respect for time. Holding forever removes pressure. It removes the need to be right today. It allows value to unfold naturally. Time rewards patience, but it also demands discipline. Staying invested during fear is not easy. Trusting slow progress requires belief. Ordinary people succeed by committing early. They decide in advance to stay the course. They remove future doubt by planning today. Time is fair. It does not care about intelligence or status. It rewards consistency. Anyone willing to wait can benefit. This makes time the greatest equalizer in investing. It gives ordinary people a powerful edge. As this chapter shows, beating the market is not about speed. It is about endurance. Those who last longest often win. In the next chapter, we will explore the greatest threat to time, human emotion, and how controlling emotions allows time to work without interruption. Chapter 4. Emotions decide results. The stock market is not just a place of numbers. It is a place of human emotion. Fear and hope move prices more than logic. Greed pushes markets up. Panic pulls them down. Ordinary people do not beat the market by being smarter. They beat it by behaving better. Most losses do not come from bad investments. They come from emotional decisions. Buying because everyone else is excited. Selling because everyone else is afraid. These reactions feel natural. They feel protective. But they quietly destroy long-term results. Fear is the strongest emotion in investing. When prices fall, fear speaks loudly. It says something is broken. It says safety is gone. It demands action. Selling feels like relief. But this relief is temporary. The damage often lasts forever. Howard Marks said, "The biggest investing errors come not from factors that are informational or analytical, but from those that are psychological." Ordinary people who understand this focus on behavior first. They accept that fear will appear. They prepare for it before it arrives. Greed is more subtle. It appears during good times. When markets rise, confidence grows. Stories of easy money spread. Risk feels smaller than it is. People invest more than they planned. They chase excitement. Greed convinces people that this time is different. Ordinary investors protect themselves with rules. They decide how much to invest. They decide when to invest. They follow the plan regardless of emotion. Rules act like guardrails. They keep behavior steady when feelings swing wildly. Experts are not immune to emotion. In many cases, they are more exposed. They watch markets constantly. They feel pressure to perform. Every move is judged. This pressure amplifies fear and greed. Ordinary people, with less attention on daily movement, often stay calmer. One of the most powerful emotional tools is distance. Not checking prices every day. Not reacting to every headline. Letting weeks and months pass. Distance reduces intensity. Reduced intensity improves judgment. Simple habits protect emotional health. Benjamin Graham offered timeless advice. He said, "The investor's chief problem, and even his worst enemy, is likely to be himself." This statement applies to everyone. Recognizing weakness is not failure. It is wisdom. Ordinary people win when they design systems that protect them from themselves. Another emotional trap is regret. After markets rise, people regret not investing more. After markets fall, people regret investing at all. Regret creates paralysis. It stops action. It clouds thinking. Ordinary investors accept regret as part of the journey. They do not try to eliminate it. They continue forward despite it. Market crashes test emotional strength. Plans feel fragile. Confidence feels misplaced. This is where preparation matters. Those who expected calm markets panic. Those who expected volatility remain steady. Understanding that downturns are normal changes the emotional response. Shock turns into acceptance. There is also the emotion of boredom. Long-term investing is not exciting. There are long periods of silence. Nothing happens. This boredom pushes people to act, to change, to experiment. Ordinary investors resist this urge. They understand that boredom is a sign the plan is working. Warren Buffett said, "The most important quality for an investor is temperament, not intellect." Temperament is the ability to stay calm, to wait, to endure uncertainty. This quality cannot be taught quickly. It is built slowly through experience and discipline. Emotional control does not mean ignoring feelings. It means not obeying them. Feelings can exist without action. Fear can be felt without selling. Greed can be felt without chasing. This separation is powerful. Ordinary people create emotional safety by focusing on life, not markets, family, work, health, purpose. When investing is not the center of attention, emotions lose strength. Balance protects decisions. By mastering emotions, ordinary investors allow time to do its work. Without emotional interruption, compounding continues. This quiet consistency separates winners from losers. In the next chapter, we will explore how simple daily habits, repeated patiently, build extraordinary results. Not through talent, but through routine. Chapter 5. Habits matter more than talent. Many people believe success in investing comes from talent. They imagine sharp minds, fast thinking, perfect decisions. This belief sounds reasonable, but it is misleading. Talent can help, but it is not decisive. Habits decide results far more often than intelligence. Ordinary people do not wake up each day trying to beat the market. They wake up and live their lives. They work. They care for family. They manage responsibilities. Their strength comes from repetition. Small actions done again and again. Over time, these actions compound into powerful results. A single good decision helps once. A good habit helps forever. Saving regularly creates opportunity. Investing regularly creates momentum. Staying consistent builds confidence. These habits operate quietly, without drama. They do not depend on mood. They do not require constant motivation. James Clear explained this idea clearly. He said, "You do not rise to the level of your goals. You fall to the level of your systems." Goals inspire. Systems sustain. Ordinary investors rely on systems. They remove daily choice from investing. They automate what they can. Automation protects them from fear and distraction. Habits reduce the need for willpower. Willpower fades under stress. Habits continue even on difficult days. When markets fall, emotions rise. Good habits keep investors steady. They continue investing. They continue holding. They do not freeze or panic. Experts often rely on judgment. Judgment changes with emotion. Ordinary people rely on routine. Routine stays stable. This difference matters during chaos. Chaos tests discipline. Habits pass the test. Another important habit is ignoring noise. Financial news is designed to grab attention. Urgency sells. Fear spreads faster than calm. Ordinary people limit exposure to noise. They check less often. They think less about short-term movement. This habit protects mental health. It also improves results. Checking investments constantly creates stress. Stress invites action. Action creates mistakes. By stepping back, ordinary people avoid unnecessary decisions. They understand that watching does not equal control. Time works best when left alone. Good habits also include learning slowly. Ordinary investors read. They listen. They reflect. They do not rush to apply every new idea. They build understanding layer by layer. This slow learning creates depth. Depth creates conviction. Conviction supports patience. Another powerful habit is humility. Ordinary people accept they will be wrong sometimes. They expect mistakes. This expectation reduces shock. When errors occur, they adjust calmly. Experts often defend their views. Defensiveness blocks improvement. Humility opens the door to growth. Consistency is more important than intensity. Investing a little regularly beats investing a lot occasionally. Ordinary people build steady progress. They do not chase perfect moments. They trust repetition. This steady rhythm aligns with long-term success. Habits also shape risk behavior. Ordinary investors avoid sudden changes. They rebalance calmly. They stay within comfort zones. Comfort reduces panic. Panic destroys plans. By respecting limits, habits protect portfolios. Charlie Munger often spoke about the power of avoiding stupidity. He believed success comes from not making big mistakes. Good habits prevent big mistakes. They keep investors from extreme bets. They keep them from emotional decisions. Avoiding disaster is a form of intelligence. Another habit that matters is patience with results. Ordinary people do not demand immediate proof. They allow time to work. They measure progress over years, not weeks. This patience reduces disappointment. It strengthens commitment. Life itself supports habit-based investing. Paychecks arrive regularly. Expenses repeat. Savings fit naturally into this pattern. Investing becomes part of life, not a separate battle. This integration increases sustainability. Habits also provide peace of mind. Knowing there is a plan reduces anxiety. Trusting the system reduces fear. Calm minds make better choices in all areas of life. Investing stops feeling like gambling. It feels like planting. The truth is simple. Talent flashes. Habits endure. Experts may shine briefly. Ordinary people build quietly. Over long periods, quiet builders often win. This chapter shows why ordinary people succeed without brilliance. They rely on structure, not inspiration. They trust routine, not excitement. And this steady approach prepares them for the next challenge. In the next chapter, we will uncover a hidden enemy that quietly steals returns. Costs, and how ordinary people protect their wealth by keeping costs low and simple. Chapter 6. Costs are silent killers. Most investors focus on returns. They ask how much they can gain. Few ask how much they are losing quietly. Costs do not announce themselves. They do not cause panic. They do not create headlines. Yet over time, they destroy more wealth than bad markets. Costs work in the background. Small fees feel harmless. Small taxes feel unavoidable. Small trading expenses feel insignificant. But time magnifies them. Just as compounding grows wealth, compounding costs shrink it. What seems minor today becomes massive tomorrow. Ordinary people learn this lesson early. They understand that every unit lost to cost is a unit that cannot compound. They respect the math. They know that keeping more is as important as earning more. This simple awareness gives them a powerful edge. The financial industry rarely highlights costs clearly. Fees are hidden in language. They are spread across documents. They are explained as necessary or unavoidable. Complexity makes costs harder to see. Ordinary investors choose clarity. They ask simple questions. What am I paying? Why am I paying it? Is it worth it? John Bogle warned investors about this danger. He said, "In investing, you get what you do not pay for." This wisdom cuts through confusion. Lower costs mean higher ownership of returns. No prediction required. No special skill needed. Experts often trade frequently. They believe activity adds value. Each trade creates friction. Taxes increase. Fees accumulate. Timing errors appear. Even correct ideas can fail after costs. Ordinary people trade less. They let investments grow. They avoid unnecessary movement. Stillness becomes profitable. Taxes are another silent drain. Short-term decisions often trigger higher taxes. Chasing quick gains feels exciting. But excitement carries a price. Ordinary investors think long-term. Long holding periods reduce tax impact. Planning replaces reaction. More money stays invested. Another cost is complexity itself. Complex strategies require management. Management requires fees. Products promise protection or higher returns. Often they deliver higher expenses instead. Ordinary people avoid what they cannot explain simply. Understanding becomes a filter. If it sounds confusing, they walk away. There is also the cost of mistakes. Frequent decisions increase error. Error creates loss. Loss compounds negatively. By reducing decisions, ordinary people reduce mistakes. Fewer choices lead to fewer regrets. Simplicity lowers the price of being human. Charlie Munger said, "The big money is not in the buying and selling, but in the waiting." Waiting costs nothing. Patience has no fee. Time does not charge interest. This makes waiting one of the most powerful tools available. Ordinary people use it well. Costs also include emotional energy. Constant watching drains focus. Stress affects health. Anxious decisions lead to poor outcomes. Ordinary investors protect their attention. They check less often. They worry less. This emotional saving supports better behavior. Marketing creates invisible costs. Promises of outperformance encourage switching. Switching creates taxes and fees. Each change resets the compounding clock. Ordinary people resist persuasion. They trust their plan. Staying put protects momentum. Many people underestimate how much costs matter. They focus on big gains. But investing is often a game of subtraction. Remove high fees. Remove unnecessary taxes. Remove excessive trading. What remains grows naturally. Ordinary people do not try to win by doing more. They win by losing less. This mindset changes everything. It shifts focus from excitement to efficiency, from prediction to preservation. Over decades, cost control creates a widening gap. Two investors with similar returns end very differently. The one with lower costs finishes far ahead. This difference feels invisible in the beginning. Later, it becomes undeniable. Understanding costs requires no advanced education. It requires honesty. It requires patience. It requires respect for time. Ordinary people who master this protect their future quietly. This chapter reveals a powerful truth. You cannot control markets, but you can control costs, and what you control has the greatest impact. In the next chapter, we will step back and widen the lens. We will explore the power of long-term thinking, and why seeing far into the future helps ordinary people ignore noise and stay strong when others lose direction. Chapter 7. The long view wins. Most people experience the stock market through short moments. A sudden rise, a sharp fall, a frightening headline. These moments feel powerful. They demand attention. They create emotion. But they do not tell the full story. The full story only appears when time is extended. Ordinary people learn to step back. They look beyond days and months. They think in years and decades. This long view changes everything. What once felt dangerous begins to look normal. What once felt urgent begins to feel temporary. Markets move in cycles. They rise with optimism. They fall with fear. This pattern repeats across history. Different causes, same emotions. Ordinary investors who study history gain perspective. They see that panic is never new. Recovery is never surprising. Progress resumes again and again. Short-term thinking magnifies fear. A single decline feels like failure. A temporary loss feels permanent. Experts react quickly. They explain. They predict. They adjust. Ordinary people slow down. They remember that markets have survived wars, recessions, and crises. This memory builds confidence. Warren Buffett said, "If you are not willing to own a stock for 10 years, do not even think about owning it for 10 minutes." This idea captures the power of the long view. Ownership replaces speculation. Commitment replaces excitement. Time replaces timing. The long view also weakens the power of news. Daily updates feel important. But most headlines fade. Stories change. Predictions fail. Ordinary people understand that news is designed to attract attention, not guide decisions. They consume less. They think more. Silence becomes clarity. Another benefit of long-term thinking is reduced stress. Constant monitoring creates anxiety. Anxiety clouds judgment. By extending the time horizon, ordinary investors protect their mental health. Calm allows patience. Patience allows compounding. The long view also supports better decision-making. When decades matter, small mistakes matter less. This reduces fear of being wrong. It encourages steady action instead of hesitation. Ordinary people continue investing through uncertainty. They do not wait for perfect conditions. They trust progress. Experts often suffer from short-term pressure. Results are measured frequently. Comparisons are constant. This pressure forces action. Action feels productive, but frequent action often harms long-term outcomes. Ordinary people face no such pressure. They answer only to themselves. Freedom improves behavior. Long-term thinking also reshapes risk. Short-term risk feels terrifying. Long-term risk feels manageable. Volatility becomes a feature, not a threat. Price movement creates opportunity for patient investors. Ordinary people welcome declines as part of the journey. They see lower prices as future growth. There is also a psychological shift. Long-term investors stop trying to win every moment. They stop competing daily. They focus on staying in the game. Survival becomes success. Consistency becomes victory. History rewards this mindset. Markets trend upward over long periods. Innovation continues. Businesses adapt. Human progress moves forward. Ordinary people who align with this reality benefit naturally. They ride the trend instead of fighting it. Another advantage of the long view is alignment with life. Life itself is long. Goals unfold slowly. Security builds over time. Investing that mirrors life feels natural. It reduces conflict between daily living and long-term planning. Charlie Munger often emphasized the value of patience. He believed waiting quietly was a competitive advantage. Few people are willing to wait. Discomfort pushes them to act. Ordinary people learn to sit with uncertainty. This ability sets them apart. The long view also reduces regret. Missed opportunities matter less. Short-term mistakes fade. What remains is overall progress. This perspective creates peace. Peace supports discipline. Ordinary people who adopt the long view stop reacting. They start responding. They measure progress over meaningful periods. They ignore noise. They stay invested. This steady presence allows compounding to finish its work. This chapter shows that winning is often about perspective, seeing further than others, thinking slower than others, remaining calm while others rush. In the final chapter, we will bring all these ideas together. We will see how ordinary people win, not by brilliance, but by balance, and why the ordinary path leads to extraordinary results over time. Chapter 8: Winning by Being Ordinary. After exploring experts, simplicity, time, emotions, habits, costs, and the long view, a clear picture appears. Ordinary people do not beat the stock market by trying to be extraordinary. They win by refusing to play the wrong game. They do not compete on speed. They do not compete on prediction. They compete on behavior. And behavior is where ordinary people quietly dominate. The greatest advantage ordinary investors have is acceptance. They accept that markets cannot be controlled. They accept that uncertainty is permanent. They accept that mistakes are part of the journey. This acceptance removes frustration. It removes the need to be right all the time. It creates emotional stability. Experts often fight reality. They try to forecast. They try to outperform. They try to explain every movement. This constant struggle drains energy. Ordinary people conserve energy. They focus on what matters: saving, investing, staying consistent, letting time work. Warren Buffett captured this wisdom simply. He said, "Nothing beats a good night's sleep." Peace of mind is not a side benefit. It is a core strategy. Calm investors make better decisions. Better decisions compound into better outcomes. Ordinary people also win by setting realistic expectations. They do not expect excitement. They do not expect fast results. They expect progress. Slow, steady, uneventful. This mindset protects them from disappointment. Disappointment often leads to quitting. Ordinary people rarely quit. Another reason ordinary people succeed is alignment. Their investing approach fits their lives. They do not need constant attention. They do not need daily action. Their plan runs quietly in the background. This allows them to focus on family, work, and health. A plan that fits life is easier to follow for decades. Experts live inside the market. Every movement feels personal. Losses feel public. Pressure is constant. Ordinary people maintain distance. Distance creates perspective. Perspective creates patience. Winning by being ordinary also means avoiding comparison. Experts compare constantly. Rankings, performance tables, benchmarks. Comparison fuels anxiety. Ordinary people compare only with their own goals. They measure progress against their needs, not others' results. This independence strengthens discipline. There is also freedom in being ordinary. No one expects perfection. No one demands constant explanation. This freedom allows mistakes without panic. Mistakes become lessons. Lessons improve behavior. Behavior improves outcomes. Charlie Munger often spoke about avoiding envy. He believed envy destroyed rational thinking. Ordinary people who avoid envy protect clarity. They do not chase what others have. They build what they need. This focus keeps them grounded. Ordinary investors also understand balance. Money is a tool, not a score. Wealth supports life, not the other way around. This perspective reduces greed. Reduced greed lowers risk. Lower risk increases survival. Survival is the foundation of long-term success. Another quiet strength is gratitude. Ordinary people appreciate steady growth. They do not demand constant excitement. They are satisfied with progress. This satisfaction reduces reckless behavior. Contentment supports patience. Winning by being ordinary does not mean ignoring learning. It means learning selectively. It means avoiding overload. It means applying only what matters. Knowledge serves behavior, not ego. Understanding basics deeply beats knowing everything shallowly. Over long periods, these small advantages accumulate. Calm beats clever. Consistency beats intensity. Patience beats prediction. Ordinary people stack these edges quietly. Experts often cancel their advantages through stress and overactivity. The stock market does not reward effort equally. It rewards the right effort, the effort to wait, the effort to stay calm, the effort to remain disciplined when emotions rise. This effort is available to everyone. Ordinary people do not need permission to succeed. They do not need approval. They do not need validation from markets or media. They need a plan. They need patience. They need trust in time. The ordinary path may look boring. It lacks drama. It lacks stories. But boredom is often a sign of effectiveness. Quiet progress rarely makes headlines. It builds wealth silently. As this audiobook ends, one truth stands above all. Beating the stock market is not about being special. It is about being stable. It is about behaving well for a long time. Ordinary people who embrace this win naturally. The ordinary path becomes the extraordinary result. Not overnight, not suddenly, but inevitably over time.